This video is not optimized for clicks. It's not optimized here for YouTube, but I still do it because it's important. I want to discuss why most people tend to lose long-term in the markets. Now let's differentiate here a bit, because if you're just long-term buying into index ETFs and you buy in the stock market, or let's say you buy a house and hold it for 10, 20 years, probably you are going to make US dollar gains. I'm not referring to that. I'm referring to active speculation, trying to beat the average market participant by being more active, by buying and selling. Most people lose with that. Now I'm saying most people, not everyone. I've shared this before. This is my track record over the last 2 years, and I have been actively trading 176 trades with an average gain of 5% per trade. So all of those trades are 100% transparent and they can be verified. I've talked about this in prior videos. And because of that track record, I think I have a unique perspective. Now, the academic perspective is that markets are efficient. I've actually studied financial analysis and I've studied investment management in Hong Kong. And that's what academia says. Markets are efficient. It's impossible to beat them. Don't even try. Just allocate to different asset classes, minimize the volatility of your portfolio, and just escape the money printer. That's pretty much what academia tells us. But why are markets efficient? Markets are efficient because some people make it efficient. Now we have to be realistic here. For you to double or triple your money, and let's just talk about relative performance. So let's say we've got a benchmark like the S&P 500 that goes up over the long term. Then of course there are long-term winners. But let's say you don't want to just get that performance. Let's say you want to outperform. You want to buy low and sell higher. That means that somebody else must be underperforming. There is some kind of a transfer happening. Somebody else is selling the low and buying the high. So money is flowing from the not so well performing people to the ones that know the game. Now, some markets are more dangerous than others. For example, the property market is not as dangerous because we tend to have very long holding durations. If we buy today and we don't have the perfect entry point, but we tend to hold for 10 or 20 years, then there's a ton of monetary debasement in between. Thus, measured in US dollars, we tend to be up after 10, 20 years. So even though it's still a player versus player game, it doesn't necessarily feel like that. Because even though you might not be the best property trader, if time has passed for long enough, you will still be up somewhat and it will still feel like a win. Even if you bought that house from somebody that sold it to you for a high price and then buys something cheaper afterwards. Even somebody else might be outperforming, it doesn't feel as bad because you're also making money. That's the property game. Now there are other markets where we don't have those long holding durations and where it's clearly player versus player. Let's say we do meme coin trading, right? Meme coins create zero value. They all have an intrinsic value of zero, but it's trading attention. Some people are able to detect that attention earlier than others. They tend to buy earlier than others. Same for perpetual futures trading, right? When we bet with leverage on a price, it's just person A betting versus person B. And person B might be the very experienced trader or entity. It might be the centralized exchange. It might be the market maker. It might be the hedge fund with all of those number crunching, and you are then trying to beat those people. Now, what differentiates the winner from the loser? Let's work with the assumption, and I think my numbers show this, let's work with the assumption that trading is not just a game of luck. Let's say it's a game of luck and skill, a combination of both, compared to, say, online poker, right? I used to be a professional online poker player. I played poker professionally for 3 to 4 years in order to pay my study fees with this. Online poker has a luck component, but it also has a skill component. We can measure the odds. We can figure out what is another player on average doing. So there are people that tend to win long-term in poker. There are people that tend to win long-term in trading as well. It's not the majority, but a minority does. And again, we have to be realistic about this. Let's say we are in a complete player versus player game, like perpetual futures trading. We've got 10 players over here. So 5 on one side, 5 on the other side. And if you want to double your capital, so let's say you're the winner over here, somebody else has to lose their entire capital stack. So let's say that's this guy over here. The capital moves from him to you. So you have 2x'd your capital now. Now let's say you want to double it again. Now in order to do that, you have to eliminate 2 others. So you're making a 4x on your investment. 3 others have to lose everything. Or let's say 6 others have to lose half of their money. Or let's say the remaining 9, they have to lose roughly a third of their capital. Now, clearly, trading is not just a game of luck. There are insiders, for example, right? They tend to make money long term, and they're just extracting capital from the others in this player versus player game. Now, what is insider trading? It is a gray zone because, yes, it's illegal to trade based on confidential information, but it's not illegal to trade based on information that you're gathering faster or that you have better insights in. The blockchain, for example, is 100% transparent, but who's actually looking at the data? Who's looking at who's a winning wallet, who's a losing wallet, what is the winning wallet doing, what are the whales doing, how many retail investors are currently buying something? It's only the very advanced players that actually look at the data. The data is available, but very few people use it. Let's say you're trading stocks, and let's say at the same time you are analyzing where all the private jets are flying, and let's say those jets are by a company, and suddenly you notice that one particular company always flies to another place where it never did before, and that other place is maybe where a competitor is based. Maybe this is a first hint that company A might be acquiring company B, or might do some kind of cooperation with company B, which could be good news. And that news is not obvious because you went through the flight records. So it should be clear, if you put in more effort than the average market participant, there's a higher likelihood that you're going to be among the winners. That being said, very few people start out as a winner. And so this is where most people fail. And that's why, for example, perpetual futures trading is so tough to beat. Let's say this here is the time axis, and this here is a measure of your skill. Over time, you should be learning more and more, hopefully, right? There are people that just always trade, they don't learn at all, but there's also other people that try to figure out, how can I get an information edge over others? How can I learn about the people that actually make money? How can I become an insider? Or how can I potentially analyze the data in ways most people are not? If you're just the average learner, let's say that's this chart over here. Let's say you just enjoy trading, you like the thrill, you don't learn as quickly, then this is your expected skill. So that's S. Or let's say every single day you try to up your knowledge, you try to network more, and you are very quick at skill acquisition. Over time, you get more skilled. Now again, trading is a game of both luck and skill. If you're the casino and you offer a roulette game, you don't know the particular outcome of that roulette game, but you do know if you play for long enough, because the probabilities are in your favor as a casino, that you will win. So it's about sample size and it's about the edge. How much edge do you have? How much are the probabilities in your favor? The more you know versus the rest of the market, the more edge you have, the more skills you have, the higher your expected value per trade. Or in other words, the higher this return should become over here, right? The 5% per trade. Ideally, I get this higher to 6, 7, 8, 9% per trade. There is volatility. There are trades that are not winning trades. This is the luck component. But if the sample size is high enough, over time, that luck component cancels out and we get our expected return. Now, here's what's so dangerous. Because most people tend to lose and there are a few winners that grab everything, the bar to win the game is quite high. So you can't just be the average. Let's say this here is the most skilled person, 100% skill. This here is a newbie that knows nothing. You cannot just be above average. You cannot just be in the 50% skill level. Because again, most people, they tend to lose to the few people that always double their capital. Now, I don't know what the ratio here is. If it's the top 10% that win, or the top 5%, or the top 1%. I know there was a statistic back in the days for poker where it was roughly 2% that won and 98% that lost. I would not be surprised if it's similar for trading, but I don't want to discourage anyone. Let's say we are at 90% are losing and 10% are actually winning. If you are better than 9 out of 10 people, maybe that's the threshold. But what does that mean? It means if you're a slow learner, until your expected value becomes positive, you have to wait for quite a long time. If you're a fast learner and you do much more theory than practice, then you're going to have your expected value breakthrough much, much earlier. Right? Then you're winning over here. You want to meet this threshold as early as possible. But since our trades are not a direct reflection of our expected value per trade, since there is this luck component, this is going up and down around our expected value. Now, what does that mean? It means we have to manage our risk massively until we finally become a winning player. We have to start out with very little capital. And once we have learned enough, once we've acquired a sample size that actually we do beat the market, then we can increase how much we are betting. Most people get 1 or 2 lucky shots. They maybe double their capital. Then they bet everything again, they lose everything, and they're out of the game. In poker, this concept is called bankroll management. So we look at how many buy-ins do we have. Let's say we've got a poker bankroll of $50. We should not play games that are bigger than $1. So we could lose everything 50 times in a row, and we've got plenty of time to learn more. Once we have doubled our capital from $50 to $100, then we can suddenly play $2 per buy-in. So what we're doing here is we're trying to minimize our risk of ruin, and we try to adapt our betting size relative to our skill. The more skill we have, the more competition we can invite. Smaller markets tend to be softer. They tend to be easier to beat. That means illiquid markets, for example, they tend to have more mispricing. Very big markets, they tend to be more efficiently priced. They're harder to beat. And again, that's because the people that have all the skills, they're not going to play on the small tables. They're not going to play the small assets. They simply can't make enough money in US dollar terms. So what do we take from that? What's our actual consequence out of all this? Number one, you want to be a fast learner. You don't just want to trade. You don't just want to follow the news. You actually want to learn how to do statistical analysis. You actually want to network with people that have deep insights into specific projects that you're considering to trade. You want to be the one that knows more about the market. If you are a car dealer, you should know about cars. If you trade meme coins, you should know who's making money in meme coins. If you're trading perpetual futures, it would not be bad to work for a market maker for a while. But let's say you are working hard. And let's say over time, your skill goes up at a relatively quick rate. And let's say you are hitting the threshold of becoming a winning player at T equals 1. What's important over here? The most important concept is you don't want to introduce too much leverage. You don't want that chance kicks you out of the game. If you have a very little leverage, so let's say you play the perpetual futures, then this is how you will make money or how you will lose money, right? This will all be losses up until you become a winning player, and then at some point this will be your gains. But let's say you introduce too much leverage. Suddenly your portfolio starts swinging like crazy. And even though you might be making a positive expected return bet, with all of that leverage, you might still get knocked out. In other words, imagine you are the casino and you have to bet all of the capital of the entire casino on just one game. Even though roulette is in your favor, if you're losing that particular game, you're out of business. The expected value of your bet is high, but your risk of ruin is also very high. I've run several backtests on many altcoins, and usually it's bad to go beyond 3x leverage. And that's already the upper end. Rather 2x, 2.5x, that tends to be the optimum if you are hedged as well. If you say bet on a falling altcoin price and then on a rising price of Bitcoin and you play that delta. If you're doing that, you don't want to go too high on leverage still, even if you're hedged. Think about it this way. Let's say you're the absolute super trader and let's say you've got a win rate of 90% and only in 10% of the trades you have bad luck because some kind of news event hits or maybe there is mispricing in the market. Let's say an Oracle dump, whatever, let's say a DeFi hack, whatever it is, right? You just have bad luck. But in 90% of the cases, you are winning. Which is of course not the case for me. Maybe this is also just an imaginary trader. But let's say that trader existed and let's say you are that trader. If you have too much leverage and in those 10% of cases, you are losing 90 or 95% of your capital, you will not be able to regain that capital quickly, right? When you're down 95% from that new basis, you need to go up 20x in order to just be back at zero. It's very, very important to manage the volatility, especially especially in the early days. And most people get greedy. Most people don't even know yet if they're a winning player or a losing player. They haven't yet gathered the sample size. They have maybe 1 or 2 very good trades. They think they're the king of the place. They increase their bets, they increase their leverage, and boom, they're out of the game. This is what usually happens, and this is what you have to avoid. You have to bet very, very small. You have to gather a sample size. You have to learn more and more over time until you've got a sample size where you're confident that you're actually winning. And at that point, once you're winning, you can increase the betting size, but gradually with the size of your portfolio and also with a reasonable leverage, not with a leverage where you can get a drawdown of your entire portfolio of 70 or 80%. Because it's very hard to recover from that. It's better to be a bit more conservative. If you feel that you're not making enough money if you don't use enough leverage, then only one of 2 things is true. Either you don't have enough of a market edge and your average trade is not a 5% winner, but maybe only a 1 or 2% winner, or your capital base is still too small. Now, if your capital base is too small, over time, this problem will resolve if you're a winning player. But if you're starting out with just say $100, then of course you can double this and you can double this again. It will take a long time until it's really worthwhile. So there is also a threshold at one point things become worthwhile. I think becoming a full-time trader only makes sense once you've got roughly 2 years of expenses saved up. Because you always have to consider, how much can I increase my net worth if I just was to sell more time, maybe with a side hustle, and save that money versus trying to trade. And if you're realistic about trading returns, it's very unlikely that you're going to make much more doing all of this risky trading versus just selling your time if you're just at a few months of expenses of income saved up. Or say it simply, let's say this is your net worth, let's say this is time. At the beginning, you're simply just saving money. You're growing your net worth linearly. But then at some point, let's say you are at 2 years of income. If you now continue to just save manually and you just sell your time, that's your expected net worth development. However, if at this point you start to get relative gains, that's then compounding. That's then going up more. But if you compound based on a very small level, then this takes forever. And you would have been much, much faster simply selling the time. So you don't want to try to turn $100 into $1 million. You want to try to turn 200K into $1 million. And ideally, you use this time over here not to make money, but instead to learn as much as possible to improve your skills. So the first months, maybe even years, are all about skill acquisition. They are about becoming one of the best in the market. And don't forget, at the beginning, you will be a losing player. And you're not trading for the money at the beginning. You're trading for learning things. A good mix of theory and practice, using small US dollar amounts until then you cross the threshold, and then you can gradually increase the US dollar amounts. And ideally, by that time, you've saved up enough with your side hustles that it's actually worth it to be a winning player in the market. Now, I know this video is not optimized for YouTube. Probably it will get a few views, but the people that do watch it, hopefully it was helpful for you. Those kinds of videos are the typical videos in the tutorial section of the premium membership. So feel free to check that out. Premium is over here. A subscription in case it's your very first time here, which is unlikely, is of course very much appreciated as well. A like, of course, as well. Thanks for watching and see you next time. Cheers.